headwinds have lingered, but somehow listed manufacturing companies have proved resilient. From consumer goods, agro-processing, and industrial stocks, all are leveraging operational efficiency, navigating price hurdles, and improving their supply chains to sustain their profit margins. And even on the NGX, the most valuable stock turned out to be one from the manufacturing sector. That's the Abdul Rabiu's owned BUA Cement at 10.6 trillion naira, and Dangote Cement is a not so distant third. But despite these strides, the sector's contribution to Nigeria's GDP appears to be shrinking. For Q1 2025, manufacturing sector's GDP grew a meager 2% in Q1 2025. So how are some of your top manufacturing stocks driving shareholder value, and can these gains be sustained? More importantly, will these strides translate to benefit not just investors, but the larger economy? Joining me for this conversation is Arnold Dublin-Green, Chief Investment Officer, Cordros Asset Management. It's a pleasure to have you here.
Thank you for having me.
All right, let's take a look. H1 2025, Consumer Good Index is up 52.2%. We have champion breweries, international breweries, Honeywell, Flour Mill, they're all minting triple digits, in returns. What's driving this, and how much, compared to what happened this time last year, it's a turnaround. So give us a picture of what's happening.
Yeah, so it's a combination of macroeconomics and micro on the business level, and I'll tell you what I mean. So on the macro side, you have, we're coming from a period of high inflation last year to really low inflation, so high 30s to low 20s. The effects reforms have kicked in, so improved stability and narrowed dollar rates and FX liquidity. And also with some of the agri, like Presco and Ecomu, there's a global macro improvement on palm oil prices. Right. So you're having the agri guys, top line increased by 100, top line revenue increased by about 100% year on year. Someone like a Presco acquired an asset in Ghana, the GOPDC, the Ghana Oil Palm Development Company, which already makes up about 20 to 25% of the top line revenue from about the first quarter of this year. Okomu, same thing. Okomu increase in exports for Okomu. Okomu exports increased by 55% or so year on year, which is quite impressive. And then on the other side, on some of the brewers that you mentioned, they had an opportunity to raise capital through a rights issue, right? So what that meant is they managed to deleverage and pay off some FX obligations. So deleverage in the sense of, if you look at the net finance costs, for example, Nigerian breweries' net finance cost has gone down by 92% year on year. International breweries' finance cost last year was about 20 billion naira, it's down to about 1.9 billion naira. So you have this improvement in deleveraging, improved balance sheets on the micro side, and then on the macro side, improvements in economics. So it's just played well.
Yeah, it's playing out well. We're seeing improvements, turnaround somewhat. But there are some that are questioning, can this be sustained, right? Is this just, okay, we had a bad year last year, we're rebounding, can we push this further? How long can this be sustained? And what would you say would be key in sustaining these gains?
So the companies that have made the right corrections and the corrections and showing discipline on their income statements and balance sheets definitely can be sustained. And on the macro side, I guess we just have to hope that the policies keep making sense. So the FX reform policies keep making sense. And inflation, as we go into disinflationary environments, the inflation continues to go lower and lower. Or the rate of change continues to go lower and lower. And then on the central bank policy side, so with a strong change in inflation or rate of change in inflation, from high inflation to disinflationary, we expect perhaps some sort of easing on NPL and policy rates, which should help with finance costs as credit growth on the banking side, or finance costs for these companies. So yes, I don't see why it won't be sustained.
Okay. Positive outlook. Let's come to BUA Foods. They're now the most capitalized stock on the NGX. Highest profit in 6 years, 36% rise in revenue. What's their... You sound a little pessimistic there.
No.
Okay. What's their story, and what's going to maintain it? They're the 10.6 trillion now.
So BUA Foods it's market share in sugar. So they have the highest market share in sugar. And one of the good names that you'll see in a nice increase in the return on equity. So return on equity is just basically giving investors more bang for their buck. That's the best way to describe it. So the market is happy with it and just keeps blessing it, I guess, right? Yeah, so
Right.
you know that you can get more money for your investment, so it just makes sense to actually go in it. So BUA Food, rather, I have no issue with BUA Food.
No
It's
issue.
fine, yeah,
All right,
yeah.
bye for you. So, I mean, going forward, there are still a lot of questions as well into how, about how things will pan out. And more importantly, yes, the manufacturing sector is doing well on the NGX. But are we seeing that translate to, the real economy? GDP, the manufacturing sector's contribution to GDP is not as strong as it, was.
Yeah, so interestingly enough, the Manufacturing Association of Nigeria put out a report a few weeks ago, and it's showing 2023, you had about 800 manufacturing businesses close shop, right? So macro headwinds, serious struggle for the industry. Our poor infrastructure, serious struggle for the industry. Our poor power sector, serious struggle for the industry. So although you're seeing some of these manufacturing guys do well on the NGX, like you said, manufacturing is up 52%, industrials are up 52%. It's unfortunately it's a small amount of what's actually happening on for the rest of the manufacturers. But on the positive side, with the headwinds came innovation. So some of these guys now source, for example, they source supplies locally to reduce costs. So some of these guys have cut the cost down by about 50 to 60% on the input costs. And you can see this change in some of these COGS, cost of goods, go down by about 10% on the income statement. So although we've had this big cuts or big chop in manufacturing industry, I think that as macroeconomic stabilize, we should start seeing contributions to GDP increase slowly, but it should increase.
All right, we'd love to get more out of you on this conversation, but our time is fast spent, perhaps some other time. Thank you for your thoughts on the show today. Chief Investment Officer, Cordros Asset Management, in person of Arnold Dublin-Green.